All right, let's jump right into it. We're breaking down the latest shipping data out of China for September 2025, and honestly, the numbers are telling a really interesting and kind of confusing story. On one hand, you've got headlines screaming about falling freight prices, which sounds like a slowdown, right? But then you look at what's actually moving through the ports, and container volumes are growing. So what is really going on? Let's get into it.
You know, the key is to know China to do better business. You can save time and money with expert insights on China trade and investment. So a huge welcome to our channel, Trade with China. Today we're going to unpack these numbers that seem to be telling two completely different stories about China's export market, and more importantly, what it all means for your business strategy.
And that really gets to the heart of what everyone's asking right now. Is China's massive export engine finally cooling off, or is something else happening? Are we just seeing a major shift in gears? The data, well, it's suggesting it's not a simple slowdown at all. It looks a lot more like a big reallocation of trade, a shift into totally new markets with new dynamics. Let's see what that looks like.
Okay, let's dive into this contradiction because it's at the core of everything. On one side, you have the shipping price indexes, basically what it costs to book a container, and they're trending down. But on the other side, the actual physical number of boxes moving through China's ports, that's strong, even hitting record highs. So how is that possible? How can prices be falling when more stuff is actually being shipped? That's the puzzle we're going to solve today.
All right, to start cracking this puzzle, let's look at the two big headline numbers that are framing this whole debate. When you put them side by side, you can really see the market's conflicting signals.
Okay, first up, here's the number that's got everyone talking about a slowdown. The Shanghai Spot Container Freight Index, which is a huge benchmark for shipping costs, dropped 12.5% in September compared to the month before. I mean, on the surface, that looks like a pretty clear sign that demand is weakening.
But, and this is a big but, that is only half the story. The latest data we have for the actual port traffic shows that in August, China's ports handled 6.5% more container volume than they did in the same month last year. So get this, prices are down, but the volume of stuff being shipped is up. That tells you right away we've got to dig deeper than just the top-line numbers.
And that's where we get to the real heart of the matter. We're seeing a major divergence in the market. China's export machine isn't moving as one giant single unit. Instead, it's acting like a bunch of completely separate regional markets, and each one is performing very, very differently. I love this analogy because it makes it so clear. Picture the whole global shipping network, not as one big highway, but as a super complex interchange. While the traffic on one major road, let's say the one heading to Europe, is getting lighter, the on-ramps leading to other places are getting way, way busier. The total number of cars on the road is still high. They're just all going to different places now.
And wow, this chart just lays it all out there, doesn't it? Look at this dramatic split in shipping rates for September. Rates to Europe plummeted by a massive 37.5%. But in that exact same time frame, rates to the Persian Gulf and the Red Sea jumped almost 12%, and rates to Australia and New Zealand saw healthy growth too. This is not one market, it's several different markets all moving at once. So let's zoom in on those European routes. The story here is pretty simple. Demand is softened. The amount of cargo is stable, but it isn't growing, and that's putting some serious downward pressure on prices. For any of you shipping to Europe, September was a huge opportunity for cost savings, with rates for Northern Europe down 37.5% and the Mediterranean down 24.4%.
Now, flip the coin completely. In total contrast to Europe, other trade lanes are looking incredibly strong. Demand for the Middle East, especially the Persian Gulf and Red Sea, is booming, pushing that rate index up over 11%. And it's a similar story for trade with Australia, New Zealand, and Japan, all strong with freight rates ticking upwards.
So what about the big one, the North American market? Well, that's a bit more of a puzzle. It was really a tale of two Septembers. For the first half of the month, rates were pretty firm. But then that peak season demand that carriers were hoping for, it just didn't quite hit as hard as they expected. They couldn't keep those prices up, and rates took a noticeable dip in the second half of the month. Volatility is absolutely the name of the game here.
And you know what? This whole split market idea, you can even see it when you look at the ships themselves, the ship leasing market. It's not like all rental rates are going up or down together. As you can see, the rates for smaller ships, the ones often used on those busy regional routes, and the very biggest mega ships, they actually nudged up a little. At the same time, some of the mid-sized ships saw their rental rates fall. It all comes down to which routes are hot and what size ships they need. Okay, so we've looked at the data, we've spotted the key trends. Now for the most important part. The big question is, what do you do with all this? Let's turn this market divergence into a real competitive advantage for your business.
All right, here's your playbook, right now. If you're shipping to Europe, the power has shifted. You should be on the phone aggressively renegotiating your contracts because the leverage is with you. For North America, you've got to brace for volatility. If you need budget certainty for the holidays in Q4, locking in your rates now is a smart move. And finally, for all those growing routes into Asia and the Middle East, expect prices to stay strong. Book your space early to avoid any nasty surprises.
See, understanding these details, looking past that one single headline number, that is how you get a real edge. It's all about seeing the many different stories that are unfolding all at once in the global trade market.
All right, let's boil this all down to the absolute must-know takeaways. First and most importantly, the market isn't just cooling off. It's diverging, it's splitting. Second, that split is creating a huge cost-saving opportunity on all your Europe-bound trade. Third, North America is choppy and unpredictable, so you have to plan carefully. And finally, those other routes are getting stronger, which means booking your capacity well in advance is crucial.
And that leaves us with one last big strategic question I want you to think about. With these shipping routes splitting so dramatically, some getting cheaper while others get more expensive and crowded, is it maybe time to think beyond just short-term deals and start rethinking your entire supply chain map for the long haul?
This channel will bring you practical knowledge to navigate business, investment, culture, economic trends, and communication tips and trades with China. Your comments really encourage us to realize our video value and update more useful information. Please press like, subscribe now for actionable insights and win-win solutions. Not to miss the possibility to understand and make money in trades with China.